Americans are taught from childhood that freedom is their defining advantage, that no system on earth values individual choice, independence, and personal agency more than the United States. And when the topic of China's social credit system comes up, the reaction is almost automatic. Horror, disbelief, a sense of moral distance. That kind of control could never exist here. Not in a country built on free markets and private enterprise. But that confidence rests on a dangerous misunderstanding. Because the most effective systems of control are never announced as control. They arrive disguised as efficiency, as risk management, as neutral mathematics, and by the time people realize what they are living under, the system no longer needs to justify itself. In America, obedience is not enforced by a single centralized authority. There is no app that displays your loyalty score. No government official openly deciding who deserves to participate in society. Instead, access itself becomes conditional. Access to money, to credit, to banking, to the ability to function inside the modern economy. Your freedom exists only as long as you remain legible to the system. Only as long as algorithms approve your behavior. Only as long as institutions you never elected, never contracted with, and cannot meaningfully challenge continue to grant you permission. And the moment that permission is withdrawn, freedom stops being a principle and becomes a technicality. This is what makes the American model uniquely powerful. It does not feel authoritarian. It feels administrative. It does not threaten you with punishment. It simply closes doors, quietly, legally, invisibly. And because those doors are controlled by private entities, not the state, the illusion of liberty remains intact even as real choices disappear. The question is no longer whether a social credit system could exist in America. The question is whether most people are prepared to recognize one when it already surrounds them. The first mistake people make when thinking about control is assuming it requires a central authority. A single government office. A visible hand issuing orders. That assumption is comforting, because it implies that freedom only disappears when someone openly takes it away. But modern financial control does not work like that. It does not need a command center. It needs alignment. In the American system, control emerges from incentives rather than decrees. Banks are not told who to punish. Credit bureaus are not instructed whom to reward. Platforms are not handed lists of acceptable citizens. Instead, each institution is given the same mandate: manage risk, protect compliance, avoid liability, maximize stability. When every major actor follows those incentives, their behavior converges. This is how a decentralized system produces centralized outcomes. Take the credit score. It is presented as a neutral measure of trustworthiness, an objective reflection of financial responsibility. But in practice, it is not a record of virtue. It is a record of participation. The system does not reward independence. It rewards predictability. Borrowing money, carrying balances, paying interest on schedule, staying permanently engaged with debt products. Those behaviors generate data. Data creates profiles. Profiles create leverage. If you never borrow, if you refuse the cycle entirely, you are not celebrated. You are penalized. You become invisible. And invisibility in a financial system is not freedom. It is exclusion. Now layer banks on top of that structure. Banks do not need to explain their decisions. They are allowed to terminate relationships unilaterally. No trial. No appeal. No obligation to disclose reasoning. From the institution's perspective, this is rational. Customers are evaluated not as citizens, but as risk vectors. Political controversy, reputational exposure, algorithmic flags, even profitability thresholds can all trigger removal. This practice has a name now: debanking. But naming it does not weaken it. Once access to banking is revoked, the consequences cascade. Employment becomes harder. Housing becomes conditional. Commerce becomes restricted. In a digital economy, being locked out of the financial system is not inconvenience. It is erasure. And crucially, none of this requires coordination in the traditional sense. No conspiracy. No secret meetings. Just shared models, shared compliance frameworks, and shared fear of regulatory retaliation. When every institution uses similar risk assessments and similar algorithms, alternatives disappear. You are told you can choose another provider, but every provider sees you the same way. This is control without a command center, A system where no one appears to be in charge, yet everyone is constrained, where power is exercised, not through force, but through access, and where the punishment is not imprisonment, but silence and absence. Control becomes most effective when it no longer feels like punishment. When it arrives, wrapped in paperwork, procedures, and administrative language, so neutral that resistance feels irrational. History has seen this before, not as an abstract warning, but as a functioning model of domination. In the Soviet Union, citizens did not move freely within their own country. An internal passport system determined where you were allowed to live, work, and exist. Access to major cities was not a right. It was a privilege granted based on usefulness, loyalty, and perceived reliability. The state did not need to imprison millions to maintain order. It only needed to deny permissions. Without the correct documentation, life simply stopped working. This logic did not disappear with the collapse of the Soviet system. It evolved. In East Germany, the Stasi refined it further. Surveillance was not primarily about arresting dissidents. It was about shaping behavior through uncertainty. Files were kept, profiles were built, decisions were made quietly, careers stalled, opportunities vanished. People were not told what they had done wrong. They were left to guess. That uncertainty was the point. Modern financial systems operate on the same principle. Decisions are rarely explained. Credit applications are denied without detail. Accounts are closed without justification. Algorithms flag behavior without revealing criteria. The individual is left facing an invisible judgment, unable to confront it, unable to appeal it, and often unable to even identify it. This is not accidental. Systems that provide explanations invite challenge. Systems that remain opaque discourage resistance. When consequences feel random, people self-correct. They moderate their behavior. They become cautious. They stay within perceived boundaries, even when those boundaries are never clearly defined. The power of bureaucratic control lies in its deniability. There is always a reason. Risk management, compliance obligations, fraud prevention, terms of service. Each explanation sounds reasonable in isolation. Together, they form a wall no single individual can climb. And because the enforcement is fragmented across institutions, no one actor appears responsible. There is no face to confront, no authority to petition. The system presents itself as neutral, inevitable, and beyond human discretion. You are not punished. You are simply processed. This is how modern control avoids backlash. It does not announce itself as ideology. It presents itself as infrastructure, and once infrastructure defines who can participate, dissent no longer needs to be silenced. It simply becomes economically impossible. Every control system reaches a moment where its true function becomes impossible to deny. Not when it is created, but when it is tested. When access is no longer quietly managed in the background, but deliberately withdrawn to shape behavior. In the modern financial system, that moment arrives when institutions begin deciding not just who is profitable, but who is acceptable. This is where financial infrastructure stops being neutral and becomes political, even when no law is passed and no ideology is declared. The turning point is debanking at scale, not isolated account closures or technical errors, but systematic exclusion justified through vague language and automated processes. Businesses operating legally suddenly lose payment processors. Individuals with no criminal record find themselves locked out of banking entirely. The explanation, when offered at all, is always the same: risk, compliance, regulatory concerns. What matters is not the stated reason, but the effect. Access to the economy becomes conditional on alignment, not formal loyalty to the state, but compatibility with institutional norms. Once that threshold is crossed, the system no longer reacts to behavior. It anticipates it. This is why initiatives like Operation Choke Point matter, even years after their official termination. They revealed a mechanism, not a policy. The government did not ban industries. It pressured banks. Banks did not prosecute individuals. They denied services. The result was economic exile without legal confrontation. Entire sectors were neutralized, not by force, but by removing their ability to transact. Once that precedent exists, it does not need to be repeated openly. Institutions learn what kinds of clients create trouble. Algorithms learn what patterns trigger scrutiny. Risk models evolve to favor conformity. No one needs to give explicit orders. The system remembers. At this stage, freedom becomes theoretical. You are allowed to speak, protest, and dissent, but only as long as those actions do not interfere with your financial viability. The moment expression threatens access, expression becomes expensive, and most people cannot afford to be principled indefinitely. This is the system's breaking point, not because it collapses, but because it reveals itself. When survival depends on continued approval, compliance stops being a choice. It becomes an economic necessity, and once necessity governs behavior, control no longer needs to be enforced. It is internalized. Once access becomes conditional, the effects do not stop at individuals or targeted industries. They spread outward, reshaping behavior across the entire society, not through fear of punishment, but through fear of exclusion. When people see what happens to those who fall out of alignment, most do not protest. They adjust. This is how control scales. Workers become more cautious, not only about finances, but about speech, associations, and digital footprints. Entrepreneurs avoid entire sectors, not because they are illegal, but because they are deemed unstable by payment processors and lenders. Investors redirect capital toward companies that score well on institutional metrics, regardless of whether those metrics reflect real productivity or long-term value. Risk is redefined as deviation. Over time, this creates a narrowing of acceptable behavior that feels organic, even voluntary. No one is ordered to comply. They simply observe where opportunity flows and where it dries up. And like water, most people follow the path of least resistance. The middle class is hit hardest. Those with extreme wealth can absorb exclusion. Those with nothing have little left to lose. But anyone dependent on wages, credit, insurance, or institutional approval lives inside a constant calculation. Say the wrong thing, fund the wrong cause, operate in the wrong gray area, and doors may quietly close. Not everywhere at once, just enough to make life unstable. This instability becomes a disciplining force. People self-censor not because they are threatened, but because they are rational. A single account closure can interrupt income. A credit score drop can derail housing plans. A flagged transaction can trigger audits that consume years. The cost of resistance is not dramatic. It is bureaucratic, exhausting, and persistent. Communities change as well. Industries cluster around compliance. Innovation becomes conservative. Cultural expression flattens, not because diversity is banned, but because divergence becomes expensive. And as each person adapts individually, the collective outcome looks coordinated, even though no one planned it. This is the final evolution of a control system. It no longer needs enforcement. It produces its own incentives. People police themselves, not out of loyalty, but out of necessity. And when survival depends on staying within invisible boundaries, most will never ask who drew the lines in the first place. Every control system seeks permanence, not through repression, but through design. The next phase of financial power is not about reacting to behavior after the fact. It is about embedding compliance directly into the architecture of money itself. Once that happens, enforcement becomes automatic. This is where programmable finance enters the picture. Central bank digital currencies are often presented as a technical upgrade. Faster payments, lower costs, better monetary policy transmission, more efficient stimulus. Each justification sounds reasonable in isolation. Together, they represent a fundamental shift in who controls not just money supply, but money usage. Unlike cash, digital currency is traceable by default. Unlike traditional bank deposits, it can be programmed. Conditions can be attached, expiration dates enforced, spending categories restricted, access toggled on and off, without human intervention. From the perspective of institutions, this is not authoritarian. It is optimal. Once money becomes software, policy becomes code. At that point, systems like ESG no longer remain abstract scoring frameworks. They become inputs. Behavioral data feeds risk models. Risk models feed access decisions. Access decisions feed programmable constraints. The loop closes. Compliance is no longer encouraged. It is embedded. What makes this transition especially powerful is that it does not require universal adoption to be effective. It only requires enough dependence. If salaries, Benefits, taxes, rents, and utilities move onto programmable rails. Opting out becomes impractical. You may be legally free to refuse participation, but economically unable to do so. And because this infrastructure is built incrementally, resistance arrives too late. Each step is framed as modernization, as safety, as inclusion, as innovation. By the time the system is fully integrated, it is no longer perceived as control. It is perceived as reality. This is how systems endure. Not by demanding obedience, but by making alternatives unviable. When money itself enforces the rules, power no longer needs to announce itself. It simply operates, continuously, silently, indefinitely. The most effective systems of control are not the ones that rely on violence or fear. They are the ones that make resistance impractical. When access to money, work, housing, and participation in society depends on continuous approval, freedom becomes conditional long before it is officially restricted. This is the defining feature of the system now taking shape. There is no announcement, no single moment when rights are revoked. Instead, people experience a series of small denials: a loan that does not go through, an account that quietly closes, a platform that suspends access. Each event seems isolated. Each explanation sounds reasonable. And because the consequences arrive individually, collective awareness never fully forms. Over time, people adapt. They optimize their behavior. They learn what not to say, what causes to avoid, what transactions attract scrutiny. They become careful, not because they believe in the system, but because the cost of non-compliance is too high. Control no longer needs enforcement. It lives inside daily decision-making. This is why the American model is so durable. It is not imposed by decree. It is distributed across private institutions, algorithms, and incentives. There is no tyrant to overthrow, no law to repeal. There is only infrastructure doing what it was designed to do. And infrastructure, once normalized, is almost impossible to dismantle. History shows that these systems do not last forever, but they often last long enough to define a generation. People do not remember when alternatives were viable. They only know the rules they were born into. And when those rules are enforced silently, most never question who benefits from them. The question is no longer whether this system exists. It does. The question is whether people recognize control when it arrives without chains, without uniforms, without orders. Because the most powerful prison ever built is the one where the doors are invisible and the guards live inside your own calculations. If this perspective changed how you see money, power, and freedom, stay with this channel. These systems are not new. History has seen them before. And history still shows how they end.